We have on our show today commercial space service providers, Awfis. We have Amit, Ramani, who's the Chairman and Managing Director, joining in to discuss the business, the prospects for FY26 and the performance of the company reported in FY25. Amit, always a pleasure speaking with you. 47% revenue jump, 48% EBITDA jump, margins up by almost 500 basis points in the fourth quarter. You've achieved a few, metrics that you had guided for earlier as well when it comes to operating seats and overall revenue growth and margin improvement. The question is, what are you targeting in FY26 when it comes to one, the number of seats that you're looking to add, secondly, the occupancy, and third, most important, what is the kind of revenue growth that you're foreseeing?
So Mangalam, thank you for having me on the program. Always a pleasure. So in terms of the guidance for revenue, we are looking at about a 30% growth year on year. So essentially crossing about 1,500 odd crores. In terms of number of seat additions, it will be similar. We added roughly about 39,000 seats this year. We would target to add another 40,000 seats in FY26. And in terms of occupancy, we have kept a good pace, right? If you look at FY24, we added, roughly about 30 odd thousand seats, and we sold about 37 odd thousand seats. What we were able to achieve in FY25 is we accelerated the number of seat additions to 40,000, but in addition, we were also able to keep pace in terms of our new seat sales. We sold 53,000 seats in FY25. So we feel this kind of a pace will allow us to continue to keep occupancy in the 70+% range for the overall portfolio and about 84-85% for the mature centers, which are 12 months or more.
That so 70,000 seats is what you did as far as FY25 is concerned. At the current growth rate, what kind of EBITDA margins are you expecting? Any significant capex, will that dilute margins?
So, from our standpoint, we are looking at FY26 as the year for building. And what we are targeted to achieve in FY26 in terms of EBITDA margin, we already achieved in FY25. So we don't foresee much change in terms of the EBITDA margin because I think it's improved significantly from FY24 and would be in the similar range for FY26. From our standpoint, we see this as a year of building where we are looking at various avenues for growth. One being our design and build services, which is basically our fit-out services, which has done well. Almost about 290 odd crores of the 1,200 odd crores came from there. We are also launched Awfis Tech Labs, where we are providing technology solutions to our client companies. We also believe mobility, which is meeting room by the hour, seat for the day, I think are areas which will grow. And then we have also launched what we call as cafeteria management services, F&B cafeteria management services. All of these avenues give us, huge opportunities for growth, but they also require some investment in FY26, and some margin improvement we see would be similar to what we saw in FY25.
Preempted my next question actually by speaking about all these things because, every time we speak, it is usually your revenue being a function of the centers that you add, the occupancy increase in those centers and the yield increase in those centers as well. The fourth dimension for revenue increase for you would obviously be these value-added services, ancillary services, so to say, that you provide, which includes mobility, F&B, and the other, meeting by the hour, piecemeal sort of projects that you're doing. If you could club all of that together and tell us, what proportion of your revenue comes in from these, and what is your ultimate target here, and by when?
So Mangalam, if you look at, design and build, that today is almost 25% of our revenue today, right? So I think that will continue to remain in that broad range because I think we believe there is a strong opportunity to be created with the level of growth that we are seeing in the Indian commercial real estate market. We feel very strongly about the design and build services, and we have built extreme leadership strength in that category. The other services is what we call under the allied services. And that piece of it, I think, are creating their own target markets by itself, right? I mean, if you look at cafeteria management, that itself is a 10,000 crore market. If you look at, the tech part of it, that's another 10,000 crores. If you look at design and build, that's another 14,000 crores. So what we are trying to do is we are trying to move from just being a real estate play where we are providing co-working and managed office to being a platform that essentially allows us to offer these services to the same commercial workplace user. It's the same decision maker for all of these services that I mentioned here. And our intent is that all of them become verticals on their own in the next 2 to 3 year time frame.
So what would the size of these verticals be? And, because it's the same customer you're upselling it to, the yields per square feet will also increase. What are you targeting on that? Give us those metrics.
So, Mangla, without commenting on specific numbers, because, obviously we have not disclosed it to the market.
That's why we want you to disclose it, right? That's what the street wants.
No. So, I mean, from that standpoint, I think we would do that probably in the next couple of quarters, because I think these avenues we are just starting to build. It's hard to give hard numbers on it, but these are some things that we will invest in FY26, and we will see reap the benefits in FY27 and 28. So maybe in the next couple of quarters, we will be able to give you more clarity.
Amit, couple of questions. I request you to keep your answer a bit brief. Number one, in terms of the existing clientele, are any of the contracts up for renegotiation, and what is the renegotiation price trend? Is it inching higher? Secondly, looking to increase prices across the portfolio, what will be the realization trend for FY26?
Yeah, so the realization trend has been approximately 5% year on year, which we have continued to maintain over the last 3-4 years. And in terms of when it's the renegotiation happens, I think it's a segment of obviously the micro market that we exist in. If the micro market has seen base rentals going up, then clearly we also get that upside when we renegotiate the contract.
And what is the current trend across your key geographies?
So approximately, I would say 5% average year on year.
All right. So this 30% revenue growth that you are targeting, how much of that is predicated on rental increase? How much of that is predicated on occupancy increase? And how much of that is predicated on you adding newer seats? Break that up for us.
It's a combination of all three. In terms of new seat additions, technically speaking, we currently are, out of the 135, we are at about 100,000 seats occupied. So even if I was to just fill these current live seats, I would achieve my FY26 target. So obviously seat addition is not that key of a metric, but yes, both the combination of, the realization improvement and occupancy improvement will impact that 30% growth.
So you said that realization improves by 5%. Occupancy you were expecting to increase by about 15%. The other comes in from, the 10% comes in from ancillaries. Is that a fair estimate?
No, not really, because if the seat the seats get occupied, right, the current seats, that will drive majority of the revenue growth. The 5% and the 10% of the ancillary obviously are a subset of that. But yes, the primary growth comes from the seats getting occupied.
Got that. Thank you so much, Amit. Wish you all the best for an exciting FY26. Well, moving on, we are excited to unveil a brand new global business